Good morning, ladies and gentlemen. On behalf of 12 Capital, I would like to welcome you to our today's webinar on current developments in the cat bond and ILS market. My name is Thomas Frey, and I will guide you through this webinar today, together with my colleagues Etienne Schwartz and Linda Hein. Most of you know Etienne already. Linda has been with us since last October and actively supports Etienne in the management of the cat bond portfolios. Now, since approximately mid-October 2023, the renewal season for both cat bonds and also private ILS contracts is ongoing. But the most two important questions we ask ourselves at the start were A, will the record high spreads on cat bonds and private contracts continue in 2024? And B, will the market continue to grow in 2024, which is also very important. That was not really given at the time in October. It is also interesting to observe how the market as a whole develops. Will there be new issuers on the market or even new diversifying risks? We would like to answer these questions and others here today. I will now hand over to my colleagues. First to you, Etienne. What can you tell us about the current development in the market?
Yeah, good morning, everyone, and welcome to this webinar from my side. I would like to start with the primary market and the maturities that we saw in the cat bond space over the last couple of months. If we look at the left-hand chart, we see that in September, the market was very quiet, zero issuances, zero maturities, and that's quite typical for the time of the year. The hurricane season is still active, meaning that investors are basically waiting and finalizing the risk premiums on that side. We see one cat bond being issued in October. That was a California earthquake bond, which typically comes during that time. And then the primary market picked up in November and December with a lot of volumes, a lot of issuances, and also diversifying perils, such as European wind deals. We saw more than in the past. We also saw cyber risk coming to the market. And in total, we really saw a big volume growth in the cat bond space. What is also typical for the cat bond market is the maturities in January. Maybe this year was a bit more in terms of volume, but that's a typical pattern in the cat bond space that we see the most of the maturities in January. As a result of the maturities, a lot of cat bond managers were actually looking for investment content, and that was basically driving up secondary market prices. And as a result, we saw some spread tightening over this period of time, and we can look into this in more detail later on. In February, the market turned again, and we saw a net volume of issuances that will also continue, even more pronounced in March, April, and May. We expect a very healthy primary market issuance and a very significant growth of the cat bond market overall. On the right-hand side, we see that we are very close. Actually, now in March, we already broke the 45 billion mark. So the cat bond market has become more mature, and secondary market liquidity increased, and we expect that we have a record year in terms of market growth this year again.
Etienne, first question coming in here. You mentioned European risks, which certainly have a diversifying effect, but are the terms and conditions also interesting for us to invest?
With European wind risks, we are quite selective, meaning that we see that a lot of deals that come to the cat bond market are not really well modeled. Some of the deals even have an expected loss, a modeled risk that is higher than the premium we get for it, meaning that this is a bad investment in the long run. So we really avoid this kind of badly priced European wind deals. And we were quite selective and underweighted over the last couple of months in these risks. But there is also some diversification benefit. That's true.
Okay, thanks.
Before we go into the spread development, I just want to give you a broad overview of the cat bond market. We saw again now a very strong start into the year of the Swiss Re cat bond index, over 3% up, and that is mainly due to the fact that I mentioned before, and the secondary market activity took record levels basically in terms of demand. What we also see is 2022 Hurricane Ian, still very significant impact on the reinsurance industry and insurance industry as such. A lot of capital was destroyed following this event, and that was basically one of the main drivers of spreads going up in January 23 as a result of that. Back then, and as a reminder, in the cat bond space, we get a risk premium and a risk-free rate. So the risk-free rate we get on the collateral that is set aside in case of an event, and the total yield is made up of those two components. Back in January, we had a total yield of around 16%. Now, if we look in 24, we are down to around 12%, still quite attractive for a non-correlated asset class, I would say, with an expected loss of around 2%. If we look at the private ILS space, we see a bit of a different picture. Private ILS rates also went up following Hurricane Ian and the recent events we actually saw in that space as well. We saw premiums in the area of 20 to 25% in January 23, and we only saw very light spread reduction, meaning around 5 percentage points of the premium. And in 24, we see that relative compared to cat bonds, private ILS transactions are basically more attractive at the moment. What has to be said on the private ILS space is that the risk, the expected loss is higher, but even adjusting for that risk, for that higher risk, we see that the private ILS space is on a risk-adjusted basis more attractive at the moment.
Etienne, there's one short question about the expected loss for cat bonds. Obviously, the expected loss in cat bonds did not increase, even if we had a sharp rise in spread levels. Is that correct?
Yes, that's correct. Actually, over the last 10 years at least, the expected loss in the cat bond space remained stable around 2%, and we expect that this will also be the case going forward.
Okay.
And what we also observed, and that's one of the drivers of the high spreads, is the losses over the last 20 years in the insurance and reinsurance space. In 23, we actually saw even, or we didn't experience any losses in the cat bond space, but the reinsurance industry had over 100 billion in terms of insured losses. And we have to look into this in more detail and split it up into primary and secondary perils. Primary perils are the ones we tend to focus on: tropical cyclones, hurricane risks, basically, in the US, and earthquake risk in the US. Those are the risks which predominantly are in the portfolios. And to a less extent, or not at all, the secondary perils, severe convective storms, flood risk, wildfires, and so on. All these frequency events which we tend to avoid if possible. And those are the events actually which are driven by climate change. If we would plot only the secondary perils, we would see that they increase over time, meaning that there is a very direct link between climate change and insured losses. And that is also why a lot of capital is being destroyed every year, and the premiums are still attractive. But again, in the cat bond space, we focus on the rare events which have a high impact on the portfolios, which are really catastrophic. That's shown also on this slide. We have a so-called peak peril strategy in the cat bond space and the private ILS space. We focus on the US wind risks, US earthquake risks. To some degree, if possible, we diversify into Japanese earthquake and wind risk, European wind risk, if the models are well, and if we get enough premium for the risk that we take.
There's just a short questions asking from a client if the underlying peak perils in liquid cat bonds and private ILS are exactly the same, or are there differences in some cases?
In the end, the focus or concentration is US wind and earthquake risks. That's the same in private ILS and cat bond space. Private ILS, however, is a bit more diversified. So it also has possibilities to go into directions which are not covered by the cat bonds, crop, for example, and diversifying earthquake perils and so on. So it's a bit broader in terms of scope, but nevertheless, the main risks are US wind and earthquake risks.
Okay, thanks.
And with that, I would like to hand over to Linda, which gives a bit more insights into industry linkers and indemnity bonds and how they are priced nowadays.
Thank you, Etienne. Also a warm welcome from my side. Yeah, as Etienne indicated within the market update, we also want to touch upon the different trigger types in the cat bond market. The trigger type in general determines how losses of a cat bond are derived, and also to a certain extent how the exposure is distributed. There are two really common trigger types. On the one hand side, the industry loss index linked cat bonds, and on the other side, on the right hand side, the indemnity trigger type. These make up the most of the market in terms of market share. For the index linked cat bonds, the ultimate net loss is related to an industry loss index. These cat bonds are often issued by larger insurance companies or reinsurers. Their exposure is distributed more over a larger region, also more evenly. As you also can see on the map, the exposure here from light to dark in Florida for index-linked cat bond is much more distributed compared to the indemnity trigger type on the right-hand side. For the index linkers, nevertheless, even though it's based on the industry loss index, the cedent can still customize the cat bond loss a bit by predefined payout factors or payout weights, where they can adapt how much of the industry loss in a certain area, in a certain region, counts towards the loss of the cat bond. Before coming to the indemnity triggers, also a word on if an event occurs. The index linker has a clear advantage in a first potential loss estimation, because we can just take the industry loss index and the predefined payout weights and derive a first estimate, which makes it a bit more transparent compared to the indemnity cat bonds. On the right-hand side, also visualized on the example of Florida, we see the indemnity cat bonds. The ultimate net loss of these cat bonds is linked to the balance sheet of the cedent. It's often issued by smaller insurance companies. The ultimate goal of these cedents is to cover or have a more exact cover of their insurance book. Therefore, the losses are much more dependent on their business strategy, but also that includes claims handling, underwriting strategy, and so on. Therefore, that cat bond carries more idiosyncratic risk compared to an index linker. In case of an event, this means that the cedent has to go out and first assess how much property is damaged and so on. That's why it takes longer to get a first loss estimate, and therefore this cat bond is accompanied by a higher uncertainty compared to the index-linked cat bonds.
There's quite an interesting question coming in. It's a bit a complex one, but I'm asking you these questions. He's asking, shouldn't models compute a higher loss now than the long historical -2 to -2.5% for the next 5 to 10 years, as El Nino might increase hurricane frequencies? How do you see the possible increased risk of flooding associated to El Nino in the Southern American states?
So the question has actually two layers. So the first is the expected loss, which is derived from long-term models, not basically taking into account El Nino phenomena or short-term phenomena. El Nino typically occurs for 2 to 3 years. So in the long run, that basically averages out. But what we have to say is that El Nino is actually doing quite the opposite. So warm sea surface temperatures in the Pacific actually reduces hurricane activity and hurricane risk in the North Atlantic. So that was actually happening last year in 23. We had a strong El Nino year, or an El Nino year, which reduced hurricane activity in the North Atlantic. So it's a bit the opposite of what one might expect. because it changes the wind flows in the North Atlantic. On the other question, South America flooding, that's clearly that has an impact based on El Nino, but we don't have any exposure in the cat bond space on flood risk in South America.
Okay, thank you.
Regarding the market share of the different trigger types in the cat bond market, so indemnity and index linker we were introducing on the last slide, there's also certain developments that we want to highlight here on the slide. We see the market share and percentage from 2020 until the end of February this year. In dark, we see the industry index linked cat bonds, and in lighter blue, the indemnity cat bonds. And we have a couple of other trigger types in the market highlighted here in gray, but they make a smaller market share overall. Looking at the graph, you see there's a tendency that indemnity cat bonds, the market share of indemnity cat bonds increases compared to the index cat bonds, that there's a decreasing tendency. We are currently at around 70% for indemnity cat bonds, while we have 25% for industry loss index linked cat bonds. Nevertheless, we think that the index linkers do have merit, and they have advantages. As I was mentioning on the last slide, they're much more transparent for first loss estimates, and therefore we overweight them compared to the market. Currently, we are around 39% in terms of weight, versus for the indemnity cat bonds, we are at around 55% compared to the market.
Linda, one question, is the World Bank still active issuing parametric bonds for some specific regions?
Yes, there's currently one cat bond in the pipeline, which is coming from or insuring Mexico, Atlantic risk, Atlantic hurricane risk and earthquake. So the World Bank is active, and it also is another cat bond in the pipeline, I think, from Jamaica, later this year. But overall, the World Bank announced that they want to use catastrophe bonds more and more. I think 5 billion in the next couple of years. So the parametric, trigger type is also something that we see in the market, because ultimately the World Bank is eager to use this trigger type as they ensuring regions that are not so common for the cat bond market, and we have less exposure data there. So having a parametric trigger type, looking only at climatic metrics, has advantages to be used by the World Bank.
Okay.
So it's not only interesting to look at the market share of these different cat bond groups, but also at their spread developments. We see that here for the same time frame from 2020 to end of February 2024. We see the spread levels or discount margin for the industry linkers and the indemnity cat bonds. Again, industry linker in dark, indemnity cat bonds in light blue. And as in the beginning already announced by Etienne, there was a spread tightening in the last couple of months or last year. This was also seen in both cat bond groups. Nevertheless, we see that it was a steeper decrease for industry linkers. So the gap between industry linkers and indemnity bonds decreased. Nowadays, it's around approximately 1%. But as we look back in history, we see the index linkers always traded at higher spread levels. This can be explained by also their higher risk levels or expected losses. So you get more return for taking higher risks. But as was pointed out earlier, these risk levels did not change so much over time. So currently, they indemnity and index linkers trade at around the same level. So indemnity cat bonds present themselves more attractive compared to the index linkers in terms of risk-adjusted returns. And that's why we currently reweight a bit towards indemnity cat bonds. Nevertheless, industry linkers still have advantages, as earlier mentioned, like transparency. And therefore, given that characteristic did not change, we still want to overweight it compared to the market.
And with that, I would like to give a short summary of what we discussed. We had the market basically having 100 billion losses in 23, which had an impact on the broader reinsurance space, but not so much on ILS, cat bonds and private ILS. And if we look into the cat bond space, we see that the cat bond market is growing, is diversifying, not always into good risks, I would say, but it's diversifying and growing. We saw and see more liquidity on the secondary market. And what we also see is that indemnity bonds, which are predominantly coming to the primary market now, pay a bit more spread. We see around 750 to 800 basis points, not the same levels as we saw in 23, but still very attractive levels in the cat bond space. Private ILS is growing, is very attractive at the moment. We see over 20% of return. The risk level is a bit higher, but nevertheless, on a risk-adjusted basis, private ILS is a very attractive asset class at the moment. And with that, I would like to go into any questions, if at all, before we then hand over to Thomas, which closes the session.
Yes, there is at least one question here. Somebody's asking about our multi-asset strategies. He just wants to know if within the multi-asset strategies, the cat bond allocation is pretty much the same like in the pure cat bond portfolios, or if it's different.
The cat bond allocation in the multi-asset portfolios is obviously lower. So we have 50 to 60% cat bond allocation. The main goal in the multi-asset portfolios is to play the hurricane season, meaning that we want to increase the cat bond allocation from June to October to take this risk premium and decrease the allocation thereafter. Cat bonds in the multi-asset portfolio stabilize the returns, but also then boost returns due to this seasonality effect. Within the cat bond allocation, it's also clear that we have more focus on US wind risk, but the tail is still lower compared to a pure cat bond strategy.
Okay, and there's another interesting question. Somebody's asking about the 2 to 2.5% industry expected loss, if this can be broken out across primary and secondary perils. If so, how different are the numbers?
Yes, around 10% out of this 2.5 or 2% is coming from secondary perils. So that's the contribution to the risk within the industry index linkers of the expected loss.
Okay, great. Now there's no further questions, but before we come to an end, I would like to briefly address a topic that is currently in the news and media. We are currently hearing and reading a lot about the fact that the surface temperatures of the oceans have never been so warm at this time of the year. This is a fact that we already had in 23. However, to conclude that we will have a bad hurricane season due to that fact is, on our view, far too short-sighted. The surface temperatures is crucial for hurricanes to form in the first place. The higher the temperature, the greater the chance of a storm developing and the more energy they can absorb. However, the mere development of the hurricane says nothing about the path or whether it will make landfall at all. In order to reach the Caribbean or the east coast of the US from the main development area in the Atlantic, which is a bit off West Africa, further conditions are required. In particular, suitable high altitude winds like vertical wind shears. It has been observed that these move further south in the summer months. You all know the jet streams, and thus push this system away from their usual path, with the result that many storms remain at sea and eventually disperse. An effect that El Niño intensifies, but which is also present without El Niño. What has also been observed in recent years is that the land masses are warming up above normal as well, which often leads then to stable high pressure systems that have also influenced the path of the storms. What I would like to say that overall a serious forecast is therefore extremely difficult. At this point in time, 3 months before the start of the wind season, anyway, cat bonds, that's what we heard before, still cover only peak peril events that occur very rarely. As a rule, they do not cover so-called secondary events such as tornadoes, wildfire, hails, etc. If at all, then indirectly. As we heard from my colleagues, 12 Capital explicitly tries to avoid or underweight these risks. An increase in the frequency of hurricanes driven by climate change has not yet been observed or even proven. However, the frequency of secondary events has. So if you as an investor always consider your investment in an ILS strategy from 12 Capital as a strategic and not a tactical allocation, on our view, you should ignore this statement about upcoming wind season forecasts. I see here there are additional questions. One last one I can ask Etienne. What is our expected return for this year for cat bonds and private ILS, considering there are no hurricanes or earthquakes?
Yes, always in the no loss case, we expect something in the area of around 12% in US dollar in the cat bond strategy, and in the private ILS space, it will be in the area of around 20%, maybe a bit more.
All right.
But that's always without any losses.
Okay. And here's another last question. What is the percentage allocation to private ILS in the portfolio?
In the cat bond strategy, we don't have any private ILS allocation, but in the private ILS commingled portfolios, we have around 30% of allocation to private ILS. The expectation is that we actually increase towards the US wind hurricane season to 40 to 50%. So that's the target allocation.
Okay, thanks very much. Now, before I close the call, I would like to draw your attention to our next ILS webinar on June 11th at the same time. Here we will provide information on what we expect from the coming hurricane season. Even, of course, by then a forecast will be very difficult as well. Don't miss this webinar. An invite will be sent to you in good time. At last, I would like to thank my two colleagues, Etienne and Linda, and I would like to thank you for joining our webinar. Stay well. Best regards from Zurich and goodbye.
Thank you.
Thank you.